Welcome to the Capital Exchange. I'm Steve Wilbur, Managing Director at Allen Capital Group.
And I'm Travis Portwood, Chief Investment Officer with Allen Capital Group.
Travis, this year hasn't been a banner year for core income or bonds, has it?
No.
Most investors aren't used to seeing bonds so negative, especially since it is supposed to be safe money in a portfolio. So let's talk about bonds and why we've seen such negative returns here in 2022.
Yeah, right, Steve. So people that have been investing for a while aren't used to seeing core bonds like the Bloomberg U.S. Aggregate Bond Index showing large negative returns. And part of the reason for that is we've been in a prolonged declining interest rate environment for some time. I mean, consider the chart on your screen right now. After peaking in 1981, the 10-year U.S. Treasury yield declined for the next 4 decades.
Wow.
Almost as long as we've been alive. Hitting about 0.52% in August of 2020, the heart of the COVID crisis. And bond prices have an inverse relationship with rates. So as rates have moved lower, prices have moved higher, and people have gotten used to seeing positive returns on bonds over the years.
You know, Travis, we all know inflation has been an issue. We've talked about it in a number of our past videos recently. In an effort to curb inflation, the Federal Reserve has been hiking interest rates, or the Fed funds rate. And the higher rates go, it leads to less borrowing, which eventually leads to less demand for goods. That theoretically slows down inflation. So anticipating multiple rate hikes in the future to help curb inflation, interest rates have moved higher fairly quickly here, which in turn has hurt bond prices in 2022, hasn't it?
It has, Steve, and all of that's true, but now's a good time to discuss a popular term used with bonds, and that's duration. And when you hear the term duration, think about it in 2 ways. First, how long it takes for you to get paid back on your bond with interest and price increases. Second is the price sensitivity of your bonds to interest rate movements. So as interest rates have moved lower over the past 4 decades, duration on the Bloomberg U.S. Aggregate Bond Index has moved higher, as shown on the chart on your screen. Lower rates equal a longer time periods to be repaid on bonds, resulting in higher duration. So now, with low yield and higher duration, interest rate spikes are magnified, and that's what investors are experiencing here in 2022.
Yeah, the natural question right now, Travis, is what do we do with bonds in our portfolio? Some people are asking. Do we even need bonds anymore? If you look historically at the worst 2-year periods for bonds since 1926, the next 2-year period, bonds have jumped or been very strong. So now may not be the best time to jump ship on your core holding if you have them.
No, now if you've been holding them, Steve, now isn't the best time to jump ship. Bonds remain a core part of people's portfolios, and prior to this year, expecting rates to move higher, we made some moves to shorten up duration in client bond portfolios to help reduce that sensitivity we talked about. But depending on your risk profile, maintaining a core bond component in your portfolio as a ballast to equity market volatility still remains prudent at this point.
Yeah, I completely agree, Travis. This has been great. I look forward to it next week.
Look forward to it as well. Thank you for watching this week's Exchange.
To make sure you don't miss out on future discussions, please follow us on social media.
Make sure to like and share our videos, and we'll see you next week.